So you mentioned just there that half of all of the crashes that we've seen have been in the last 25 years. So they're becoming more frequent. So should we expect major crashes more often nowadays?
Yeah, I do worry that is the case because the speed of information is just so much faster. However, remember, history doesn't repeat itself. So it's really difficult when you've had different kinds of crashes, especially, and I'll kind of go through these in a sec, whether or not there's any real pattern. So in other words, late 1990s, 2000, dot-com bubble happened, and then interest rates were cut really low to support that. And people were like, oh, I'm not putting my money in stocks. Oh, I'll just put it into housing as my other asset. Then the housing bubble, which then started to crash in 2007. So that's only about 7 years, 7 years. And then 2008, it implodes, right? Global financial crisis. And then the Euro crisis happens 2 years after that in 2010. And that is in what I describe as the slipstream of the global financial crisis, because European banks were already struggling. And now they've got a loss of confidence in terms of sovereigns, countries like Ireland. And now we have another crisis. And that's just a couple of years since the start of the 2008 banking crashes. So then you have sort of a number of crashes. And this is something that happens quite a lot. They're not great crashes, but they're still pretty big crashes. I don't write about them because, you've got to draw your line somewhere. But I do write about the fact in, 2013, emerging markets had suffered what financial analysts called a taper tantrum. So, the Fed was going to cut back its money printing, and then emerging markets were really struggling. 2015, China has a major currency crash and stock market crash. Companies on the FTSE 100 here had their biggest one-day loss because of that crash since 2008. So that was consequential, but didn't lead to a recession. So I don't write about that. So now you know where I'm going, right? We're in 2015. So now you're beginning to see the recovery of the NASDAQ. You're beginning to see the tech sector really grow. And then all these, highs that were hit in 2019, and the end of the year, COVID hits. So then after that, you're like, this is absolutely global pandemic. This is causing tons of misery beyond financial stuff. February 2022, Russia invades Ukraine. Now we have a cost of living crisis. And so then October 2023, Israel, Hamas. So we have had a lot of shocks that have contributed to cost of living crisis, various things. But I think I'm kind of drawing out this timeline because I do think lots of people feel they're the crisis generation. But because these crises all come from different drivers, still really important, I think, to learn from history and to say, well, okay, the financial consequences of this is, I can see this pattern, in every crash. But what can be quite interesting and very frustrating is that we'll take the COVID-19 crash. By the end of the year, lockdowns happened in 2020. By the end of 2020, start 2021, vaccines were coming on stream, which is incredible, by the way. Financial markets hit record highs in January 2021. So I write about in the book the average person, people, the rest of us, were, suffering from all the economic consequences of that. But financial markets were hitting record highs. We saw this after 2008 as well. In America, they describe it as the difference between Wall Street and Main Street. Here, I guess it would be the high street and the city. It doesn't rhyme. But, financial markets recover, but the economy does not. And this dichotomy, I think, is very, very concerning for a lot of people who think, well, hang on, all the policies that have helped, the rich get richer, and the rest of us are still suffering from the crash or the austerity.
If someone is participating in the markets, hearing about all these crashes is pretty worrying, but a consistent investment approach in a broad index over that time would have produced excellent returns, even with all those crashes, which is kind of amazing, isn't it, really?
Yeah, that's absolutely for the, what we just said about the pandemic, the S&P 500, Dow Jones, multiple highs, world MSCI or world index record high. But what's fascinating is the NASDAQ, after the dot-com bubble, took 15 years to recover. So you would have had to be an active stock picker to pick the Amazons. So if you look at Microsoft, Cisco, they struggled throughout that entire period to go back to the valuations they had at the peak at the end of the 1990s. So again, Mark Twain clearly is brilliant. History doesn't repeat itself, so different crashes generate different dynamics.
That was a clip from a recent conversation we had with Linda Yu about financial crashes. If you want to see the full episode, then just click here.